But first, we have to talk about today's big story, and that is inflation and the Fed. Producer prices seeing their biggest decline since October. This coming after consumer prices cooled more than economists had expected in the latest report yesterday on Wednesday. Still, the Fed remaining cautious, only forecasting one rate cut this year. When asked about the risks of waiting to cut rates, here is what Fed Chair Jay Powell had to say.
We understand that if we wait too long, that could come at the cost of economic activity, of employment, of the expansion. We understand that if we move too quickly, we could end up undoing a lot of the good that we've done and have to then start over, and it could be very disruptive. So we're extremely aware of both of those risks.
Joining us now, we want to bring in Mohamed El-Erian. He is Allianz Chief Economic Advisor, as well as our very own Julie Hyman here joining the conversation as well. Mohamed, it's great to see you, and thanks so much for taking the time to join us. I want to start with what we just heard, that soundbite that we just played here from Fed Chair Jay Powell. He's saying that the Fed is acutely aware of the risks here to both sides, saying that the Fed, once again, reiterating remaining data dependent. I'm curious, though, of that downside risk of the Fed waiting too long. What exactly do you think that could look like, and the odds of that actually happening at this point?
So I think Chair Powell is correct in pointing out that there are two tails to the soft landing. The soft landing is what he's targeting, but there are risks on both sides. I think what he misses is the balance of that risk, that the balance, unfortunately, is in favor of them being too late and the economy slowing more than it should, and small businesses and low-income households being hit particularly hard. You ask, what is that probability? I put it at 35%. There's a 35% probability that they may end up too late. Now, the good news is not above 50, but it's a pretty fat tail that the Fed should be very, very attentive to.
Mohamed, it's Julie here. It's great to see you. So at this point, when is too late? Do we have a decent idea of the timing of when the Fed should begin cutting and when it actually is likely to begin cutting?
So in my opinion, too late is what is reflected in yesterday's SEP or dot plot, which is the possibility of one hike. And let's remember, 4 people said no hikes. And if this is the normal Fed hiking cycle, that one hike would come in December. So that, in my opinion, would be too late. By that time, the lagged effects of what was a significant increase in rates would be biting even more. Already, the cushions that small businesses have and poor households have already been eroded. Pandemic savings have gone. Debt levels are high. Delinquencies are going up. So I worry that if they carry through on what is in the SEP, that will be too late. Now, the good news, Julie, is I strongly believe that they had the CPI data a couple of days earlier, and they had today's PPI data, we would have gotten a different SEP.
And while you're mentioning the SEP as well, you say if they carry through. Well, we know that, the SEP, we sort of take it as a very loose guide. I think Powell himself has sort of alluded in that direction. So, how should we as investors read it?
Well, we should read it as the markets are reading it today and yesterday. Ignore it. That's exactly what the market did. If the market had taken it seriously, it would have seen first 2 cuts go to 1. It would have 3 cuts go to 1. It would have seen 4 people expect no cuts. It would have seen a higher inflation forecast for this year, and it would have seen a higher estimate for neutral rate. That's a real hawkish tilt. But the market, for the reasons you've cited, are saying, well, you know what? I'm going to ignore that. And that's why we're seeing the rally in both fixed income and in equities. And I think that's the right thing to do. There's part of me that thinks that the SEP is excessive transparency, excessive communication.
Well, they are excessively communicating, Mohamed, but not always the same message. We heard a lot of dissent, and we saw a lot of dissent in that dot plot in particular. So I'm curious from your perspective, if you think the Fed has lost the plot a little bit, and given the amount of dissent amongst the voting members, is that potentially more harmful than helpful at this point?
Madison, lots of people think that. And if you look at the questioning yesterday, the chair was really pressed on, wait a minute, this doesn't make sense. I think what you're getting is the consequences of what I call excessive data dependency. The Fed made a very big mistake in 2021. They took a forward-looking view of inflation. They said inflation was transitory. They held on to that belief for too long. And as a result, we had a massive hiking cycle, including 4 consecutive hikes of 75 basis points. So I think they were so shaken by that mistake that they became just backward looking. And this is an excessively data-dependent Fed. When data itself is very noisy, which it has been, and the market has reacted up and down in terms of yields to that market, to that data, that volatile data, they end up coming across as confused. What the Fed desperately needs is to have the courage to take a forward-looking view of what the economy is going to do and stick to that view and anchor the markets better.
I think Nick Timiraos in the Wall Street Journal called it inflation PTSD in his discussion of the Fed and its mindset right now. Mohamed, the last time we talked, you said, when you're looking at all this backward-looking data, one of the places you go to find sort of more forward-looking data is actually company conference calls, earnings calls. And I'm curious, since we last spoke, what you are gleaning from those calls.
What I'm gleaning is what the forward-looking indicators are telling us, as opposed to historical data, is that demand is weakening. You hear it over and over again in the different corporate calls. You see it in sentiment. And that's why I think that the risks that we started this interview with the Fed chair clip is asymmetrical, Julie. I think there's a much bigger risk that we weaken faster than the Fed expects, than the other risk that inflation ends up much higher than the Fed expects.
Mohamed, are you concerned about some of the weakness that we are seeing within the labor market? And we talk about how maybe much more of a focus the Fed should or maybe will be placing on some of the softness that we have been seeing. What are your thoughts there and just the risk that this ultimately poses here, obviously, to the broader economy?
No, I worry about it. And I worry about it, Seana, because there are no buffers anymore. If you are a low-income household, if you are a small business, you're highly reliant on whatever income you're generating. You no longer have the buffer or the access to the debt markets that you had before. So that if something goes wrong, in the case of household, it would be if something goes wrong in the labor market, then it will not be linear. This economy will not weaken in a linear fashion. It risks weakening in an accelerated fashion. I look back at different hiking cycles and followed by cuts. And the one that soft landed in my lifetime, and I'm old, is 1995. And there, the Fed cut pretty early. All the others have ended up in bad news because the Fed tended to be late. This data-dependent Fed, because it's so backwardly looking, is so reactive in its reaction function that it risks being really late.
Mohamed, I want to end by asking you about something we talk about a lot with regards to those company earnings calls that Julie mentioned, which is the AI boom. And there's this idea that AI is going to drive so much corporate efficiency moving forward. How much do you factor that idea into your overall macro outlook?
I certainly factor it when I go beyond 1 year to the 3 year and the 5 year. What AI can do to productivity gets translated into bigger but not hotter. It will allow us to grow more faster, but it will not mean that there'll be a speed limit in terms of inflation. The speed limit will be better than it is now on there. Now, there are labor consequences. There's all sorts of other things we have to pay attention to, but it is truly a productivity enhancing tool that will move the supply side in a favorable way and that will allow us to grow better over the long term.
All right, Mohamed, we're going to have to leave it there. Thank you so much for joining us. That was Mohamed El-Erian, Allianz Chief Economic Advisor, and thanks to our own Julie Hyman for bringing us this interview as well.